One of these days I may actually break down and buy it. But people don't realize it actually had a purpose.
That's a pretty cool.
Well, hello, welcome to the ERM Advantage podcast. This is Eric Holmquist. Today in studio, I'm very excited to have a longtime friend and colleague, John Soffronoff, join us. John has been in the banking industry for a long time. He started out originally as an examiner with FDIC, but for the last, 20 plus years, has managed a number of very successful risk and compliance advisory practices. So one of my sort of go-to experts, particularly in the compliance arena, which is not my strong suit. So John, thank you for being here today.
Delighted to be here, Eric, and thank you. It's an honor.
So we're going to just kind of cover a range of territory around financial services, sort of the trajectory of things, and obviously the regulatory environment, and always appreciate your perspective on how things are changing, evolving, and all that. But again, I mean, obviously we've been around the industry a long time, and we've seen things come and go and change. Why don't we just start high level and maybe just kind of give me your thoughts on sort of where you see the industry and kind of what sort of trajectory it's on, as of today.
Yeah, sure, Eric. So, I mean, I think probably the biggest topic that is affecting the industry is AI. You can't go 2 minutes without having another AI conversation. Why aren't we using it? Why should we be using it?
Yep,
What could we be using it for? Why aren't we saving money yet? It is definitely the topic du jour, and certainly not just in financial services, but across all industries.
Couldn't agree more. Absolutely.
Yeah, I think it's fascinating the push and pull of how much can we use AI to enhance the way we conduct our business, enhance the customer experience, improve processes, things like that. But also the people side of it and the concern, do we want or do we expect the people that are doing these processes today to help figure out how to eliminate their jobs by turning it over to AI? And I think that's probably the hardest challenge that organizations have to deal with. I mean, clearly the sound bites are that jobs aren't going away. We're not replacing people. We still need people. We may need people to do different things. But then the core challenge of that is, do we have the right people doing the right things? And maybe the people that are doing some of these, manual processes aren't going to be the people that are doing the new things. And of course, in the larger institutions, it's almost a little bit of speaking out of both sides of their mouths. On the one hand, saying, we're not eliminating people, but on the other hand, we're eliminating 30,000 jobs or 3,000 jobs, or depending on the size of the institution. So it's a challenge.
And this is just, again, it's all crystal ball stuff. I think you hit the nail on the head that this could change how we do a lot of things. I think there's going to be a lot of reimagining processes, and it'll be a while before the dust settles on what is the role of AI versus the role of people. And I think we're doing a lot of sort of experimenting, and we'll see. That makes sense because I think there's a very clear efficiency use case and capacity use case. I think that the question is that, is this a game changer in some way? Does this enable some sort of new product or new direction, or does it fundamentally change banking, or is it really principally just sort of gives us better capability, capacity, efficiency, et cetera?
Yeah, I mean, I think that, the core services are still going to be the core services. Banks are going to take in money and lend it out, and then you have the investment side as well, of course. But so payments, deposits, and lending are really probably the core services that banks offer, and I don't think that's going to change too much. Probably the biggest change is speed. Yeah. I mean, I think that's what AI really brings, and ultimately probably accuracy and effectiveness. So yeah, I mean, I think that's really what we can look forward to is faster.
I agree, and I mean, I've always been a big data proponent, and I've I've long been lovingly critical that people don't use their data more and in better ways. I just feel like and this is not just banking, this is every company. I think is aware that they don't leverage the information they have as much as they could. And I'm hoping this also creates new capability to be able to use data better because, in theory, AI should be able to better recognize patterns, expand our ability to interpret. Now, I do want to wrap back on this topic when we get back to kind of the regulatory environment and how you sort of examine and regulate this, but that's another can of worms. So let's table that one. Sticking with banking in general, I know you've been around M&A and seen that. Do you see? I mean, look, it seems like every couple of years we say there's only going to be 30 banks when the dust settles, and it never happens.
Right.
What is your perspective on new banks, M&A, how the bank might change, number of institutions and that sort of thing?
Yeah, I mean, I think that, clearly there's always going to be the money center banks that handle a lot of the international aspects and, work with the Fortune 500 companies and have the capabilities to handle those. But I also believe that there's a really important role that community banks play on Main Street. The smaller businesses that really represent the majority of our economy, they depend on community banks that, understand their businesses, can welcome them at the door, can offer them, timely products and services that are fit for purpose, that and also the advice that they need to be successful. So you're not going to necessarily get that from the money center banks. So I think it's vital that community banks still.
Yeah, I agree. I agree. I've always been skeptical of at some point the big banks are just going to buy everybody up. To me, I think you're right. There's always a space there for a bank, figuratively in the neighborhood. I know for a while, it was some concern about the regulatory burden was getting a lot that may force some banks out. But I think the more pressing reality is we got a lot of bankers getting ready to retire, and could that also fuel at some point? Look, do we really want to restock our leadership shelves or just sell the bank or something? Could that drive some of that?
Yeah, I think that's a great point. And, I hope that many banks are addressing the succession planning because I think it's absolutely important. And I also hope that many of the community banks recognize the importance of it. Some banks are absolutely committed to staying independent and, are not going to participate in the M&A. And those banks definitely need to be thinking about succession planning. I mean, I guess I can give an example of my father's bank. He was very diligent to make sure that there was a succession plan along the way. Now, he went through a couple of mergers and acquisitions, but at the same time, he knew who the successors were going to be to run the bank going forward.
It's nice having banking in your blood.
Little aside, my parents were both tellers at PSFS, and that's how they met. So, yeah, it is kind of in my blood, literally.
Let's talk about, fintech a little bit. And we've seen, a lot of evolution in this space, and there's a bifurcation of fintechs which are, partner with banks and just bring better, faster, cheaper. But there's also a segment which is they intend to compete with banks. And so we often talk a lot about the disintermediation and, at some point, do people trust Apple more than they trust Bob's Bank, or First State Bank or whatever? Right. What are your thoughts on sort of the trajectory of fintechs and how much of this is a resource for banks and how much of it do you think is a threat to banks?
I guess banks can look at it as both. I think it's very individualized, where a bank wants to fit in the market, what their target market is, who their customers are, And then, are there gaps in the products and services that they offer that could be fulfilled by partnering with a fintech versus, selling into a larger institution? So, I think that's where, the organizations really need to take a step back and look at, what void are they trying to fill? And then, what's the best way to fill that void? Is it to develop the product and service in-house? Is it to partner with a fintech? Is it partner with a correspondent bank? There's different ways to achieve that.
Yeah, and I 100% agree. And I've seen some instances where a institution said, we really need to do better at this, or we need to offer this product, we don't have it. And it's a lot easier if there's a company that already knows how to do that, and they can do that. On the competitor side, if we've seen, again, some fintechs that sort of want to be banks, but it seems like it's a lot of ankle biting so far. But we've also seen the players, the Apples, the Walmarts, the Googles, have sort of made attempts, but they've never really figured out how to become this monster, bank.
Right.
Do you see that happening? And if that does happen, does that suddenly create a real existential threat to traditional banks?
Yeah. I think that it's very important that banking be separated from commercial enterprises. The risks to the overall economy and financial system of blurring those lines are pretty significant. And so, I think that it's important that we draw that bright line. I would say that, commercial enterprises providing banking services like payments, that's probably, and obviously we're already experiencing it. But, it's not insured deposits. It's not the broader financial services. So I think within the payment space, it's certainly legitimate. And who are they competing with? They're competing with the money center banks. That's not really going to take market share away from the community banking.
Yeah, and in some of the future podcasts, I've got some folks I know that they live in this ecosystem, that they work with these fintechs, and they get very excited about their capabilities. And I think that's great, and I'm always hopeful there is a better mousetrap that somebody come up with. But you've heard me say before, I think my perspective is in 10 years we will need banking, but will we need banks? And I think you hit the nail on the head that while there's always going to be technological improvements, and again, people are going to find better, faster, cheaper. And look, when was the last time somebody under 40 walked into a branch?
Right.
Exactly. So, banking I think could definitely change. But it's hard to imagine a scenario where my entire banking relationship is just a computer.
Right.
And some customer service number that I can never get a hold of anybody.
Exactly.
I can't believe, certainly at least in our lifetime, that it would become a pure technology play.
Yeah. And I guess, Eric, also distinguishing the personal banking from the business banking.
Yeah.
And I think that's really where, probably the biggest difference is between the money center banks and the community banks, is that the community banks, while it's nice to have the personal banking, and most of the time that personal banking is related to the small businesses that they're also banking. So, they have the overall relationship, but, regular employee that needs a personal banking relationship, they're probably going to be at a money center bank because of the convenience.
Right. Yeah. And I think too, there's a broader point about just the financial ecosystem and how might this change. And this is going to lead us down a direction of kind of digital and alt currencies, but I want to hold on that because that has some arms and legs I want to be able to kind of unpack a little bit.
Okay.
Other than that, any trends that you see as interesting, or either interesting or frightening or whatever, around banks in general?
Certainly the regulatory space has changed dramatically under the current administration. So I think that's something that we need to contend with. The debanking aspect, which is a really interesting component because, like, internally, if you think about, the C-suite and risk and compliance, the executives in the business side are saying, there's less regulation, there's less that we have to do from a compliance standpoint. But at the same time, now you have this debanking concept of, taking on what would have been previously characterized as very high risk businesses. And, that's opening the door up of the bank to now have to contend with that. So while on the one hand, maybe there's less regulatory pressure, from consumer protection, there's probably going to be more responsibility to monitor these higher risk accounts that the administration wants banks to rebank.
Yeah, and that's a great segue. So let's talk about the regulatory environment. And again, we've seen this flow back and forth as to what are the areas of emphasis, and tends to shift with different administrations. But, in general, what does the regulatory environment kind of look like right now, and sort of where do you see it going in the near term?
Yeah, I mean, I think overall, if you look at from the top down, the CFPB obviously has had their wings clipped, not as strong enforcement. You have a lot of the other agencies, the FDIC, Fed, and OCC, that have fewer examination staff now because of the buyouts from last year. And from my experience, there seems to be a softer touch even at the exam level. I think banks have to be cognizant, though, that the pendulum will shift back. It will moderate, and then
Right.
even potentially go back the other way. I think a couple things that are pretty important to remember. One is that if or when the pendulum does shift back, that there's always a look back period for
Be careful what
areas.
seeds you're putting in the soil.
Exactly. And the laws and the regulations haven't changed for the most part.
Yeah.
So the banks are still required to comply and follow the law. Maybe there's less regulatory pressure to do that, and maybe there's less enforcement, but still, there's potential for civil liability, and then there's also potential for a future examination that maybe is under a different administration that finds something that was non-compliant, and now the look-back period goes back to a longer period of time that all of these things could have been happening. So I think that's pretty important. The other aspect is, of course, the states are getting more involved. So definitely the states that have more progressive views on consumer protection and things like that are, stepping up their enforcement.
California, New York.
Exactly.
Yeah. No, that makes sense. And in the near term, like say during this administration, do you see any other changes coming that might be kind of in the works, or do you think the dust is kind of settled, in this term?
Yeah, it seems like it has settled. I guess what would be interesting is what would the reaction be to a crisis that hasn't happened yet. Obviously things have been buoyed pretty nicely for quite a period of time, but what if something happens? What's the administration's reaction to that? How does the finger pointing start? And then what expectations will there be on the financial services?
That's a great point. We this is what great risk managers are. Is we're always willing to ask the question, but what if? Because we hope and expect everything all goes well, but again, Murphy was an optimist. I've for a long time have made the provocative statement that I think we have too many supervisory agencies, and I've talked to lots of colleagues about this. Some agree, some disagree, and I have advocated for some time now that if I had my magic wand or the power, I would rather see supervisory authority brought into maybe one or two agencies, and let the Fed deal with money supply, let the FDIC deal with insurance, and because I often see a lot of inconsistency in how banks are examined and priorities. I mean, would that be a good idea, or would that have unintended consequences? What do you think?
Yeah, I have always advocated for it. I think it makes total sense. When I started my career in 1990, we were kind of in the middle of the S&L crisis, and the talk at that point was rolling the OTS up into the OCC. And maybe even potentially broader. And even though my job was with the FDIC, and I might have been out of a job if that occurred, it seemed like it made more sense that you have one supervisory and enforcement agency, you have the Fed with monetary supply and their aspects, and then you have the FDIC for the insurance aspects. I mean, it would make more sense. And you're right that the inconsistencies, maybe not as much right now, but certainly in the past, you had regulator shopping, and
Right.
and that could change, not just regulator to regulator, but also depending on the region that the bank is located. So fast forward from 1990 to 2008, and then we have the financial crisis, and finally the OTS does get merged into the OCC. But there were a lot of former regulators that were advocating strongly for further consolidation, and that would have been the perfect time to have it done. And I'm still surprised that it didn't happen.
Yeah.
But I still think it makes more sense to have one agency. And with Doge and obviously the change in the overall employment base in the regulators, maybe this is an opportunity to take a step back and look at it. But I haven't really heard much.
I'm not sure if that's on anybody's radar.
Mm-hmm.
I think there's probably bigger fish to fry, but I don't know. Just it seems to me like there's some efficiencies to be gained, but also some consistencies to be gained.
Right.
And you're right. I mean, you've seen instances where, in one region, the regional team was all wound up about X, and the other region, they didn't even ask about that, or they gave it a light touch. And I've seen that particularly in some topical areas. One area was just on a rampage about InfoSec, and one area of one agency for a while was an absolute obsessed with model risk and had some interesting ideas about how that should be managed.
Right.
And they're never the definitive authority, but to me, I don't think it's unreasonable for the industry to say, guys, you might want to kind of get your story straight.
Yeah, I think, Eric, maybe a good example is the Community Reinvestment Act, where, even as we were contemplating some, or I say we, even as the government was contemplating some changes, each of the regulatory agencies, was not totally on board. So, it's kind of ridiculous that you have a law that applies to all banks, and yet, not each regulator has a different view on how to roll that out, and each regulator has their own implementing regulations for it. So, yeah, I mean, that's a good example where things really ought to be all under one.
Yeah, it's funny you mention that, because I at some level, I was actually pleased that those changes were sort of put on ice, only because some of the changes that were planned, I don't think made sense.
Mm-hmm.
I think, look, there's always you can always sharpen the spear on how do you manage an area, but I mean, some of it just seemed like a lot of needless data gathering for data that's just not going to be meaningful.
Right.
So, is it time for a refresh? Probably. Was that the right structure? I don't think so. So, to me, I think the lesser of all evils was, okay, let's just ice this for now and step back and think about it.
Yeah.
I think there's a lot of areas of regulation that probably could use a fresh coat of paint.
Mm-hmm. Yeah, no doubt.
But, make it make sense.
Yeah.
And I think, again, given that sort of my focus is always risk management, central to that is what's the real risk?
Yeah,
and
I brought it up more, though, like to demonstrate, why do we have 4 different regulations 4 different implementing regulations for the same law.
Right.
And not whether I agree or disagree with what the regulations require, but more it's just confusing.
Right.
When, under one structure, you're required to follow the OCC's regulations. Under another structure, if you're a state non-member bank, you follow the FDIC, and if you're a state member bank, then you follow the Fed.
Yeah.
I mean, it just seems so strange.
Yeah.
And then, of course, you have credit unions, and that's a whole different.
Well, that's I'm glad you mentioned that's worth just touching on for a second because, obviously, you talk with our bankers and it's mentioned credit union, the hair on their back of their neck gets up. And, I've said for some time that, for a long time, I think credit unions serve an important purpose, but that purpose has really changed. Mm-hmm. And I think it would be not an unreasonable thing to say that they have a strategic advantage in the way they're chartered. But at this point, they're really pretty much banking. They're offering the banking services. So is it time for us to take a look at that charter and think about whether it still makes sense?
Yeah, I mean, I think so. And I mean, I guess if I was going to play peacekeeper with the community bank and the credit unions, my philosophy would be that credit unions should be a good alternative to the money center banks for personal banking. And it makes sense, right? If it's organized around an employer or if it's organized around a particular geography, that's totally appropriate. The fact, though, that credit unions have been allowed to then get into commercial lending and small business lending, and that just seems to me to be outside of the original purpose of a credit union.
Right.
And that's where I would draw the line. I would say, credit unions, personal banking, absolutely compete with the money centers, provide the individualized service for your constituents, but stay out of small business lending because that's really the purview and domain of the community bank.
Yeah, and I go, this is a provocative topic, but
Mm-hmm.
I don't think it's a great leap to say it is a material advantage they have in how they're structured, and I'm not sure it makes sense anymore. But again, who's going to take that one on? Because
I mean, I guess if you consider like a savings account as almost a commodity, is it okay for a credit union to exist to provide savings accounts and then use that money then to lend it to make an auto loan or a mortgage loan? Yeah, I mean, I guess you could argue that deserves, kind of a nonprofit type of existence. But, expanding then into the other financial services with those same economic advantages, not having to comply with CRA, not having the tax, I think that's where it does get a bit unfair.
And just sort of less point around the industry, obviously, particularly with community banks, the value proposition is generally we do service better than everybody else. Okay, I think it's a narrow value prop, but that sometimes that's their story because at the end of the day, checking is checking for the most part. But again, as technology evolves and things like that, do you see any real strategic differentiators that you can see happening where, as we go forward, a bank could really stand out? Or is it really just going to continue to be just how much can we service our customers well?
Yeah, I mean, I think that's really what it comes down to. I suppose on the technology side, and again, I think it's so important to distinguish the personal banking from the business banking. Personal banking, the technology is so important because the speed that you can do things, the ease that you can access your accounts and make payments, and then also obviously have the security that you're not going to be exposed to fraud, and when you send a payment, it's going to the right place. All those things. I mean, I think that in the personal banking space is really important to consumers. On the small business side, though, advice and somebody to talk to, and it's almost like a wealth advisor. You want to have, there's going to be a place for the robo advisors that have pretty streamlined. I have to roll my 401k into an IRA, and you have your age, and you can figure out what investments. AI could do that, but for a small business, when they need to have that personal relationship to advise on, how to deal with their accounts, their lending relationships, when to borrow, when to pay down. There's so many things that a banker can help them with.
Yeah, and I think that makes a lot of sense. All right, we're going to take a quick commercial break, and we'll be right back.
One of the most important questions you can ask about your enterprise risk management program is it helping you make better business decisions? Or is it simply taking up a lot of people's time without creating any value? Is it helping you gain a better understanding of your business? Or merely documenting what you already know? The tools and resources available from ERM Advantage are built specifically to help any organization get the most out of their risk management programs. We have the largest library of free content covering proven best practices in enterprise and operational risk management. We have developed industry-leading tools and templates for every aspect of the program, including risk appetite, risk assessments, risk monitoring and reporting, and so much more. All available at a fraction of the cost of developing these tools from scratch. We are ready to assist you with program development or enhancements, board or leadership training, or reviews of existing programs. Contact us today to see what best-of-breed risk management can look like in your organization.
All right, welcome back. I'm here with John Soffronoff, and we're talking about kind of the industry and all that. And we've been talking about trends in the industry and banking and the regulatory environment. You've spent a long time managing teams and companies that work with clients to help manage risk and compliance. So you've got a lot of experience working with the good and the bad, the ugly of people's risk and compliance programs. So I want to just kind of, pick your brains a little bit. And, when for banks trying to build a strong compliance program, are there any kind of best practices that you see that you really do stand out from clients you've worked with?
Good question, Eric. If I was going to point to one thing that is a make or break, it's tone at the top. If the executives do not believe that compliance is important, then it's not going to be important. And without that appropriate tone at the top, the rest of the program really doesn't matter. So I'd say number one, that has to be in place. And then really the rest of it is just basic blocking and tackling.
Yeah.
Having the right culture, which of course is influenced by the tone at the top. But, our culture is to comply. Our culture is to do the right thing. Our culture is to serve the customer. And, I think that's just as important. And then, like I said, the rest of it is really just blocking and tackling, aligning your understanding the requirements for the products and services that you offer, doing risk assessments, following up with monitoring and testing to make sure that we're in compliance, providing training, strong policies and procedures, clear delineation between first line, second line, and third line functions. I think those are all, the basic blocking and tackling.
Absolutely agree, and that's perfect foundation. So now we can sort of we can pick apart a couple of aspects, and I think there's a couple of things that how I sort of think about like a risk management program versus a compliance program. One of those I think is sort of the timing of things, and oftentimes when we're talking about compliance, the question comes up: if we're not doing it right, how will we know? And so if the answer is, well, next quarter we'll do a test to see. Okay, but that's a quarter from now, and meanwhile we've been doing it wrong for the next several months. And as compliance programs evolve, and perhaps you could unpack how you could strengthen them, how we think about implementing, technology and AI. Can there be a move towards it's less about a quarterly review and more about something that's a little bit more alive?
Yeah.
So that if we are kind of heading towards the guardrails, we'd know.
Yeah, that's a good question. So, I think there's a couple layers of monitoring and testing. So, you're right that a lot of programs, you have internal audit that handles the periodic reviews, and they may do integrated audits where, throughout looking at a business line, they're testing compliance, and then you might have thematic audits where they're looking at a particular regulation. But you're right, that's only happening maybe at most once a year. And then within the second line, you have the compliance monitoring, where they may have a schedule throughout the year that they're looking at particular areas depending on the risk assessment.
Yeah.
They might decide to look at some things every 18 months, some things every 12 months, sometimes quarterly, depending on the severity of the regulation or the impact, like HMDA. They might do a HMDA quarterly review just to make sure that things are going well. So that brings us then to the first line, and I think that's where there's a couple opportunities. I mean, the manual aspect of it is quality assurance, or doing a second set of eyes on different transactions based on risk of where things could potentially go wrong. But I think the way the industry is moving and the opportunity with AI and technology is to have more real-time monitoring, where you can build in functions that you can't go past a particular screen unless the information's been entered and validated. So it builds the compliance controls in the process. So I think that's where we're evolving.
Well, and I think part of how I've seen this and helping to see it is, as we continue to get better at automating stuff, less and less is being done in spreadsheets and Word documents, which are static, as opposed to being done in a solution,
right,
where that solution is going to have the potential for red flags. You didn't fill this in. This doesn't make sense.
Right. So
I think that may bring some capabilities, where something could be watching the data in real time and where alarms going off. It's always disappointing to me when we discover something and realize that this has been going wrong for some time. And there's a certain amount of, well, shame on us. How did we not know that?
Yeah, exactly.
And I think it also reinforces, training and being clever in your training. So I was trying to think, people should be thinking less like a compliance person versus a risk manager. Do they understand the risk of this and what it means? And going back to that culture point, and this is a tricky one. You are so spot on that I've always said risk management lives and dies on culture. And I think some of the more difficult environments have been one where, I've worked with clients where the unspoken, if not spoken, view of the board and sometimes senior management was, look, do just enough to keep the regulators happy. And, I've seen this movie. I know how it ends every single time. And, God, the number of times I've talked with senior people who said, I'm just fed up. I just have to wait until we get slammed by the regulators, until they sort of figure it out. Well, I hear you. I feel your pain. I'm not sure that's the strategy you want to go with, but maybe you'll get lucky and they do get slammed. But it goes to this idea of people can't think like a risk manager if they're not getting that message.
Right.
And I've done quite a bit of board training and try to sort of instill this idea that if all you ever thinking about is just complying, you're just buying time. Okay.
Exactly.
You're putting seeds in the soil. This is a ticking time bomb. I think when I've talked about risk management, I have an advantage in that some risk management practices can be a strategic differentiator. There's aspects that we can really help be a better bank. In the compliance world, I don't know that's as much of my motivation. It's still fun. We have to comply. Are there any other little tips or tricks that you have found that just help the board or management or whatever think more about this is good risk management versus we're just having to tick a box so we don't get in trouble?
Yeah, I guess, Eric, if I was going to bring that same thought process into compliance, being a better bank, a lot of times where non-compliance surfaces is in consumer complaints. And, you can look to the root cause of some of those consumer complaints as being not following a regulation or, not following a process or a policy. Because in most cases, the processes, the policies are designed to enforce compliance, right? So, is it true that fewer consumer complaints means I'm a better bank? I would argue probably that is true. So, there is maybe an argument made for being in compliance, reducing complaints, and being a better bank.
Actually, that's a really good point. I've said for a long time, I think complaints is probably one of the best metrics you have, because if that number is going up, something's wrong. But that's also a very short hop to how your customers are perceiving you.
Exactly.
And this is no longer about stuff that is our dirty little secrets. It's getting out.
Yep.
And it doesn't take much for that suddenly to start to really bubble. I mean, look, people get on social media, and enough complaints can go viral, and all of a sudden you've got a contagion out there.
Yeah.
So that's a really good point.
Yeah, I think it's interesting maybe, in the context of reputation risk. Reputation risk, while it's not a focus of the examination anymore, it's still a real risk.
Right.
And something that probably needs to be considered in these contexts. Right?
Uh-huh. It is one of the bank's most important assets.
Yeah.
And, I think particularly as banks, I think the reality is they have to think beyond banking just their footprint, because now you're no longer competing with the bank next door. It's the bank in the next state.
Yeah.
And so how do I extend my coverage but still extending both my customer service and my control? And this gets tricky, because banks are sometimes looking to wade into deeper waters, whether it's geographically, products, or whatever.
Yep.
And just because we were good at doing something locally doesn't mean we're going to be good at doing it in the next state.
Absolutely.
Because there could be whole new tripwires. In the compliance world, are there any really common sort of tripwires that you just tend to see again and again that people tend to trip up on, that maybe even with somewhere it's like, God, shame on you. How did you not know that?
Right. I mean, still, it's outstanding that, or mind-boggling, I guess, that there's still banks that mess up their anti-money laundering programs. Aren't properly doing the enhanced due diligence and understanding the customers, or failing to identify high-risk customers. This is a law that's been around for a long, long time, and still, there's plenty of enforcement actions. Some of the basics on the mortgage side, HMDA reporting, that's pretty straightforward.
Yeah.
And, sometimes the information just doesn't get collected, or, the data lineage is off and it doesn't flow from system to system. Some of the more complicated regulations like TRID, that still, I think, banks are struggling with, although there hasn't been as many mortgage originations, certainly not refinances for a while. So it's not as critical, but it is still a complicated tripwire.
And in those areas where you often see, like I say, they trip up, was the solution better people, better training, better systems, better checks? What is there common answers as to what you should have been doing or should have been doing better?
Yeah. I guess I'll take it back to the tone at the top, because, in some institutions, it's only a violation if we get caught. So, there wasn't an investment in making sure we did it right. In other institutions, it would be certainly the intention was to do it right, but we didn't have the right people doing the process. Maybe they weren't properly trained, or they didn't have the right processes or procedures to follow. And then in other situations, it's just like a misinterpretation.
Yeah.
They thought that's what the regulation required, and it actually, didn't. So.
Again, a certain amount of kind of shame on you.
Yeah.
So let's circle back to AI.
Okay.
And again, I think we very much agree that this will improve our capability stack and allow us to do things, but it's a whole new black box. And I remember going back years ago where banks started doing more automating, and in the programming world started creating kind of these black boxes. We saw this with vendors.
Right.
That is an analytic tool where data goes in one side and comes out the other, but we don't really know what happens inside. AI is just the black box on steroids. It's the same thing. Data goes in, data comes out. And one of the challenging areas has always been, how do you know what's happening inside the black box? So we talked a bit about how banks could use this. And again, I think it will bring some interesting capabilities. What's going to be a regulatory perspective on how banks use AI when there's things going on inside the machine we can't verify?
Yeah. I think it's maybe consistent in some ways to like internet banking. Like if I was going to draw an analogy, it took a long time for the regulators to take a step back and evaluate the impact of internet banking on all the different laws and regulations. And ultimately, for the most part, the requirements of the laws and regulations applied to internet banking just as they applied to, coming into the branch or conducting a loan in front of a loan officer. And I would imagine that, that is the approach that the regulators are taking with AI, is that, we have this framework, we have this structure of laws and regulations. It's up to the banks to determine how does AI impact, our compliance with these particular laws and regulations. And of course, the obvious example is underwriting. So, there's certainly very clear requirements about anti-discrimination and things like that. Well, if the bank is going to start introducing AI into their credit underwriting process, how do they ensure that it's non-discriminatory? And so, I don't know if, clearly there's going to be maybe more industry wide requirements, maybe not industry specific, but across all industry requirements for AI, just because of national security and things like that. But, when you get into the weeds of how do you actually apply it to a particular function, you have to look at, well, what are the existing laws and regulations that apply to that function? And then, what's different about how AI is being used than the way it was done previously?
Yeah, and I agree with you. I think there's two things I would observe that time will tell whether I'm right or not. One is, from what I've seen, the use cases so far, again, whether it's underwriting or financial crime and alert monitoring, the use cases I've seen is using AI as just a better crunching tool, or an enhanced crunching tool, but still limited to AI gives a suggested answer. And then the bank has to decide, does that answer make sense, and be able to defend that answer. The threshold I have not seen crossed is, which would be really a full application of AI, which is it can run on its own and make decisions and implement things, like, for instance, around like alert clearing. It's used in a lot of these solutions to look for patterns and things, and it may suggest other rules or behavioral characteristics you might want to follow, but it's never been allowed to just put those rules in automatically. Same with underwriting, it can't implement its own underwriting rules. And I don't know I see that happening anytime soon. I think, at least for the foreseeable future, it'll be a good tool to help us observe things, do better analysis, but not just let it go and make its own decisions. And I think the area that I think right now is sort of the forefront of how we manage this is really the model risk area, because this is going to be close to all your models. And I know I've got some colleagues that have demonstrated some pretty good capabilities on how you could actually validate an AM model even if I can't get under the hood.
Right. Yeah.
Whether that's some parallel testing, some challenger models, whatever, or some tests with test data. So I think we'll see some good innovation on how to manage it, and hopefully regulators leverage that learning.
Yep.
But it's one of those numerous things that I said I'm glad I'm not in their shoes. And in addition to that, I want to talk really quickly about digital, because again, this is another evolving area, and so there's a whole lot of, I don't know, we'll see. But I kind of like the tack that the administration is taking around digital and crypto and all that. Is I think it makes sense to explore something like a stable coin where it's always tethered to a currency. Then all you're really doing is taking advantage of the technology, the platform. Looking at a crypto, but obviously with a certain amount of sort of skepticism, and basically banning a CBDC, which I've said many times would be the dumbest thing we could possibly do as a country. So I think that there's still a lot of we'll see about how this ends up permeating, but I think it's reasonable to say that at some point, the reality is that a digital currency is part of our financial ecosystem. It's obviously going to have some impact on payments. So this is all still kind of crystal ball. The use cases are still evolving. But just give me your perspective on the digital currencies, how it might affect the payments world, and also how you think the regulators will approach regulating something they don't have full control over.
Right. Yeah. I mean, I am pleased that the use case is in the payment space. I mean, I think that is where there is tremendous value. If we can have a system that prevents fraud, provides instant payments, and allows money transfer, within the guidelines of anti-money laundering, I think there's something to be said for that. To be honest, I don't really see the need for any cryptocurrency that is not pegged to a
fiat currency or something.
Currency,
yeah,
right?
Yeah.
I mean, I don't understand it, to be honest. I really don't understand Bitcoin and things like that, like why somebody would invest in that. There's the only basis for the value is what somebody else is willing to pay for it.
Yeah.
And, there's no underlying value. You could be selling Pokemon cards or whatever.
Right,
I mean,
right.
It doesn't make sense to me. It's not something that I've embraced from an investment standpoint. But, on the digital currency pegged to a fiat currency and facilitating safe instant payments, I mean, I think that's a no-brainer. Yeah,
there are some use cases, and I completely agree with you. I've said for some time that the currency itself is it's a novelty. It really has no underlying value because it's an underlying asset. And I think everything we're seeing today is simply prototypes of what we may see. But you can't deny the technology, and in some use cases, like in international stuff, this could be a better mousetrap.
Right.
But it does open up a new can of worms. I think that's the good news is more and more you'll be advising clients on how to implement programs to implement digital in their environment and manage risk, manage compliance.
Yep.
But again, I think we're still fairly early innings.
Well, I think it's interesting you bring that up because you can certainly apply the same governance requirements to digital as AI, and I think it's important that as banks consider either one of those is that they have a very good program around each of them. It's not going to be perfect out of the gate because there's still a lot of things that we need to learn, but you need to set up policies around it. You need to set up controls around it to make sure that there's knowledge about where it's being implemented. The last thing you want is just for people to be doing their own thing. You have to have guidelines. You need to have guardrails around, how that's being implemented, where it's being used, and then make sure that it's being reported so that it can be monitored and tracked.
Yeah, and in a upcoming podcast, I've got a colleague that again he lives in this world,
Okay.
and I know enough to be dangerous. I mean, I can explain how it all works, but what does it mean?
Yep.
I would only be able to rough that out. But again, if we look at sort of the horizon, I've said for some time, I think that where we're inevitably heading is banking that is less based on a dollar through a service bureau through the Fed as more of a wallet-based system where I can be flowing multiple currencies. And that's going to fundamentally change how banks manage things, because now you're talking a variety of different kind of currencies or tokens or whatever.
Right.
And it's going to exponentially, I think, complicate a whole lot of things, but I think this will take some time. Got a few minutes left, and I want to just talk about a technology, but I know you've been working with some institutions about thinking about automating and GRC. And, I think some of that is again, just efficiency plays. It's obviously in the risk and compliance world, you can get to death by spreadsheet pretty fast. and look, there's nothing to say that I could run the world on a spreadsheet.
Yep.
And they can be very powerful. The desktop tools can be very powerful, but there's an inherent inefficiency there. So I think the reality is that there's some efficiencies of using automation. Also, you can do a lot more. You can use the data more. I can analyze, present, whatever. So, what do you see as some sort of driving factors in thinking about automating, and when's the right time to automate, and what maybe to prioritize when thinking about automating risk and compliance?
Yeah, great question, Eric. As I've been thinking about this, it's when maybe it's a similar situation as banking overall with AI. And looking at the environment today, I mean, there's huge obstacles to challenging a bank. Obviously, you have to get a charter, you have to have deposit insurance, a lot of those things. So, banks aren't as threatened by AI or maybe even fintech, to our prior conversation. In this space, though, you have existing suppliers that were built on a foundation that, may not even apply in today's environment. And so what's the barrier of entry into these areas? Before, it was a lot of coding, a lot of development time, and, what's the reward? Well, hopefully you're building a better mousetrap, but the amount of time that it would take to roll this out, it's pretty difficult to make that business case.
Yeah.
Today, with AI and low code, no code solutions out there, I think there's a bigger opportunity to challenge some of the existing systems and put forth a system that really is more fit for purpose. And I think also can be very industry specific. Many of the tools out there are, give you the framework, but it doesn't provide the content or the approach necessary to manage risk and compliance within a community bank or a credit union or a regional or money center bank. So, I think there is an opportunity right now to take a step back and reevaluate, what are these areas? And to your question about the low-hanging fruit, clearly risk assessments are one area. Testing is another area. Risk appetite, strategy, you could, start to think about. But what also is interesting, I think, is the ability to access more data, whether it's data from your core systems or external data sources, and incorporate that into the GRC environment is pretty exciting.
Yeah, I've said for years that the ultimate GRC system hasn't been written yet, the advantage of not being aligned with any one technologies, I'm free to hate them all, or I think some do some things clever, but I think your point is spot on, that they're built on a certain use case and premise, and that needs to evolve. And I think we are going to see some change here and how these tools are used, because I think in many ways they've just be seen as just automating things we're doing, but that's not really where their value would be.
Right.
It's giving me a platform where, yes, I can automate risk and compliance, but I can also use this now as a knowledge base and learn from it. And I think that's going to be the differentiator, but in a way that is agile.
Yeah.
It can adapt, it can grow with my business, and I can actually learn from and not just document what I already know.
Exactly.
So just to wrap up again, you've worked with so many institutions and you've seen the good, the bad, and the ugly. Any sort of final thoughts, if you had one sort of word of wisdom around strong risk and compliance management, what would that be?
I would strongly suggest that banks do not get complacent in the current regulatory environment. Having worked through remediation projects across, a number of different topics. So it's not just BSA AML, it's not just HMDA, it's not just truth in lending disclosures. There are so many things that could go wrong that if you take your eye off the ball, you may be finding yourself in a look back situation. And an ounce of prevention is clearly worth a pound of cure in this case.
It's always easier to do it right the first time because, we've seen some look backs. They get in some pretty serious numbers. And in every one, there was a sort of a sense of, oh, God, if we had just done this right. Originally, then we wouldn't be here we are. Because that, you get into that situation, that's going to have a long shadow because, with what you do and with your regulatory relation.
Yeah, absolutely.
So, well, this is great stuff. Well, John, thank you so much for being with us today.
My pleasure, Eric.
Your insights are always so valuable.
And congratulations to you on your studio and your podcast. This is fantastic.
Thank you. All right. That's all for today. Thanks for watching.
The ERM Advantage podcast is recorded at Lightshed Studios, Philadelphia, Pennsylvania. Copyright 2026 ERM Advantage LLC. All rights reserved. To inquire about appearing on the podcast, please contact us at ermadvantage@gmail.com.